our product training, I want to just break down for the newest people a little basics of life insurance, and then talk about the part that we do and we focus on the most, because it's 98% of our business. Okay. And so with life insurance, right, there's two types of life insurance. What are they? Term and what? Permanent. Okay. There's term and permanent. Okay. A term lasts for a certain amount of what? Time. Usually 10, 15, 20, or 30 years. And usually this is positive because it's more affordable, or you can use the word cost effective. What's the downside? That's all you got to know. In general, $1 million, 20-year term for a 40-year-old is about how much? Yep, $30 to $40 a month. If you're younger, is it going to be a little more or a little less? A little less. If you're older, it's going to be a little more, a little less. A little more. If it's less death benefit, it's going to be a little more, a little less. Less. If it's more death benefit, a little more, a little less. Right? More. That's all you got to know for term. Okay. Permanent life insurance is what? Yeah, it's permanent. Right? It lasts till you're what age? 121 years old. And in general, it's 7 to 15 times more than term. General. What's a number in between 7 and 15 that's easy to calculate? 10. So just general rule of thumb, if $1 million for a 40-year-old is $30 to $40 of term,
300 to 400.
Yeah. And if it might be 500, but it's just a way for you to calculate it easily in your mind. Somebody asks you and you need to give an answer real quick. It is little simple things, right? $1 million is probably more like 500 or 600, but what's 15 times 400? Times 40, sorry, is 600. So it's, I'm just giving a range. And it doesn't really matter. You have to just be able to talk about some of these things very quickly and easily. Like when you're out, somebody asks you, or if you're on the phone, you want to be able to dumb it down, right? No matter whether you're talking to somebody that makes 30 grand a year or has a $60 million business, right? That guy, what was his name yesterday? Luca, right? Like, I didn't talk to him any differently than I would anybody else. Like, in fact, thanks, babe. In fact, I talked to him very, very simply. He only asked me 3 questions. Remember what they were? How much money can you borrow? What's the
how much money can you dump?
Yep, and how much? What's the
what's the
rate?
interest rate?
Yeah, that's all they asked me. And how much? What's the loan to value against the cash value?
Yeah.
Like how much of the cash value you pull, right? And you want to just give people ranges of things, right? These are top 3 questions that people ask me all the time. Is how much of the cash value can you borrow? What's the answer?
90%.
Yeah, 90 to 95%. Emeritus is 92. One America is 95. People ask me, what's the interest rate when you borrow? What's the answer? 4.5 to 6.5%. I just like giving those range. Penn Mutual is 6.2. And if you work with Northwestern and New York Life, it's going to be more than that. But like, that's what I say. And then the other question is, what's the rate of, and what's your answer? I like to say it's not really like that. Yeah, but some people want to play that game, so I don't want to sell myself out of it either. Because it depends. If you look at an illustration, right? If you look at rates of return and you actually look at year-over-year growth, depending on how you structure it, it can go negative 94% return in year 1. Technically, right? If you put $2,000 into a policy and you have $116 of cash value, like you're losing that money, but it's buying life insurance, right? It's not, you're not losing it, but I'm just showing you the reality is how some people might look at it. Or you look at an illustration, they put $2,000 a year into the policy and the cash value is only $116. They're losing, quote unquote, their money. They could have just kept it in the savings account and would have still been 2,000. Right? They could have went to Las Vegas and possibly made it 4,000.
Or lose everything.
Or lose it. But I'm just giving you an example, right? And then as time goes on, like 5, 10, 15, 20, 30 years down the road, the returns can be as high as 500% plus. It just depends on the situation. So you want to get out of this conversation. It's not really like that, is my answer. Because in life insurance, you receive dividends. And it's a profit share of the life insurance company. And it depends. But historically, say dividend rates are between 5 and 7% for the last 20 years. This is my response to that question. So it's not really like that. You receive dividends. It's not a rate of return. It's dividends that's based on profit sharing from the performance of the life insurance company. And historically, dividend rates are 5 to 7% for the last 20 years. That's the answer. So you want to just be able to break this down very much and very easily. And this book is not about investments of any kind. It is about how one finances the things in life, which can certainly includes investments. It is not about the rate of return. And as time goes by, interest rates go up and down, but the process of banking goes on no matter what's happening. It is a well-known fact that banks make more money during times of low interest rates than when rates are high. Right? So if you're an investor, do you want rates to be high or low? You want rates to be low so you can get a good return on your money. Now, if you're a banker, it says that bankers make more money when rates are low, right? So you want rates to be low because we're becoming our own bankers, right? But it's a different conversation. So sometimes a lot of times you have to say to someone, hey, I know you've been conditioned this way. This is a different type of conversation. And so I'll do this a lot. Right, you got to take off your consumer hat where people don't want to pay interest and don't want to go into debt and don't want to borrow money, and put on your banker hat where you make money on all of the interest, borrowing, and debt that's out there in the economy. And then look at it through that lens. And you got to talk to what we do is very niche. Right? Like it's 0.03% of all life insurance agents do what we do. There's another 3% that think they know what they're doing, but they're not. Right? And so it's important to understand that a word of caution is in order. Later in the book, you'll be looking at illustrations of life insurance companies that show how the concept works as compared with how most folks go about solving their financial affairs. Most of the illustrations were developed in 2000 and represent dividend scales that are in effect at that time. Presently, interest rates are lower and hence dividend scales are lower, but in comparison with other methods of financing the things in life, the difference in results remains the same. It is not a procedure to get rich quickly. To the contrary, it requires long-term planning. All right, so you have to think long-term with this thing. And it's totally okay to let people go. You got to let people go. You got to be able to let people go easily and effortlessly. Your job as a salesperson is not to convince everybody. It's to do what? Sort for the people that are open to what you have. All right, so you have to sort. Your job as a salesperson is to go into this ball pit. Right, you've all been to a ball pit where you jump in as a bunch of those balls, right? And your job is, hey, imagine if you were in a ball pit and I told you that you would become a millionaire if you just bring me the 3 black balls. Okay? If you pick up a red ball, what are you going to do? Throw it away. If you go down and you think, and you find a blue ball, what are you going to do? throw it away, right? You're going to be in there throwing the red and the blue balls away so that you could find the black one. And in sales, you got to be on the phone and do what? Throw all the people that don't want your stuff away. And you get on the call and they're like, this looks ridiculous. I just was watching a video of Dave Ramsey and he said whole life is a scam. You have two options, right? What color ball do you have in your hand there?
Red.
A red one, right? If you have a red ball in your hand, you have two options. You can either do what?
Punch it until it becomes black.
Yeah, I was gonna say, yeah, punch it until it comes black, or turn it black with a marker, and it's gonna take a long time. Or you could just toss it away and go look for a black one. You have to be really, really good at sorting, right? One of the best things that has to be ingrained in your mind, and you're gonna have to remind yourself this, is that amateurs convince and professionals sort. And so on the phone, what are you looking for? The black ball. On a Zoom call, right? Sometimes you might not be able to see the color of the ball, or they might be disguised as a black ball. And then you get on the phone on Zoom and you realize that they just had a black suit on and really they're a red ball. And then it's your job as a salesperson to easily and effectively exit the conversation. Hey, thank you so much for your time. I'm going to send you all the information that you need to make a decision. Here's my cell phone number. I appreciate you. You know where to, when you are ready to make a decision. And that's it. And you let them go. And then where are they going to be? They're going to be rotated in with all the other leads. And they'll get called by somebody else later. And who cares? But you got to let them go quickly and easily and effortlessly. Right? Too much time is spent. Right? What are the other factors of permanent? What are the pros of permanent life insurance policy? Cash value. What else? But what are the two types of permanent policies? Okay. What's the biggest difference? One word. This is. And this is guaranteed. That's it. That's all you got to say.